What is the correct amount of life insurance you should have on your life? Do you really need any life insurance? Replacement value is a concept you should be very familiar with. Statistically, by the way, guys tend to die, women tend to linger. Delceti Capital Management, LLC, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Delceti and its representatives are properly licensed or exempt from licensure. For additional information, visit www.delceti.com with a hyphen between the L and the S. Hey folks, welcome to episode 2, season 1 of the Happiness to Retirement Program podcast. I'm Bill Delceti, founder of Delceti Capital Management and creator of the Happiness to Retirement Program, because the road to retirement should be an adventure, not a survival strategy. So let's get right into it. Today's episode is all about determining what is the correct amount of life insurance you should have on your life. And there are numerous approaches to this calculation, but there's only one, I believe, that is the correct amount, theoretically speaking. And so we're going to run through 3 different scenarios and 3 different approaches to determining how much life insurance you should have on your life. But before we get into that, let's talk about the concept of insurable interest. And the concept of insurable interest simply means that if somebody does not suffer a financial loss if you pass away, then do you really need any life insurance? Or actually, can you obtain any life insurance on your life if nobody suffers a loss if you pass away? And the answer to that is no. So first and foremost, and this makes sense, if nobody has insurable interest on your life, then you can't get life insurance. No insurance company will underwrite you if there is not an insurable interest. And that makes sense, because why would you even consider life insurance if nobody has an insurable interest? The flip side of that is your spouse has an insurable interest on your life. Your kids will certainly lose out if you pass away. Maybe your grandkids, maybe even friends or a charity, or the business that you work for or own certainly would suffer an economic loss should you pass away. So first and foremost, there needs to be an insurable interest before we even consider how much life insurance is appropriate. Okay, so now let's talk about the different approaches to determining just how much life insurance is necessary. And I'm going to start with this idea of what we call an income replacement, or a rule of thumb approach to determining how much life insurance you might consider. And so I'm going to assume in this case that we're talking about a married person, and they have, let's just say, 2 kids. They're 30 years old in this case. And one rule of thumb approach is replace 5 years of the person's income. And so forgetting about inflation and raises and things like that, if we just use a very simple rule of thumb approach like this, a 5-year income replacement means that if you die tomorrow, then your family, you should be insured for $750,000. And that is the amount that your family would receive. Okay, better than nothing. The chances are when you got married and had kids, you were making plans for a lot longer time period than that. And we're assuming that you were going to work for a much longer time than that. But what's the consideration here? Cost. If insurance were free, then you would have 5 years, you would have more coverage. But in any event, so that's one approach, very simple rule of thumb, some multiple of years of income, 5 years, 7 years, 10 years. And that's better than nothing. It's better than nothing, but probably, in fact, almost 100% certain to leave you woefully underinsured. Let's talk about a second approach. The second approach is a needs-based approach that takes into consideration other financial obligations And it's going to result in a bit more life insurance than the first rule of thumb income replacement approach. So a needs-based approach might work something like this. Well, you decide that, well, we want to set up an education fund for our kids, and that's $200,000 we're going to put away. And we're going to replace 5 years of my income at $150,000. So that's $750,000. We want to pay off the $400,000 mortgage. So the $400,000 mortgage plus the education fund at $200,000, $600,000. And then we have the income replacement at $750,000. So you have $1,350,000 in coverage. Now that's about double the amount of the simple rule of thumb, replace some portion of my income approach. So it's better, certainly a larger amount that your family certainly could use should you pass away than simple income replacement approach. But now let's talk about the theoretically correct amount of insurance that you should have. So I'm going to talk about a concept that is really important when it comes to asset protection planning and insurance and insurability. And the idea is replacement value. So when it comes to asset protection planning, the concept is, what is the amount truly at risk? What needs to be replaced? So if we talk about homeowner insurance for a minute, it's pretty simple. If your home burns to the ground and it's worth $1 million, but you have replacement value coverage for only $600,000, when that home burns to the ground, the insurance company is going to cut you a check for $600,000, say, sayonara, have a nice life. And you're going to have to make some really tough choices about the fact that you can't rebuild your house the way it was. Instead of 4 bedrooms, you may already now can have 2 or 3. Instead of the chef's kitchen with the granite countertops and the beautiful stove, maybe you're going to have to make some decisions there that you're not going to like so much. Maybe you're not going to have a bathroom on the first floor. Who knows? So replacement value is a concept when it comes to insurance. You should be very familiar with. And oh, by the way, we will have another podcast about homeowner insurance and replacement value there. But it's a pretty easy concept to understand. What about your car? If you drive a BMW and it's worth $100,000 and you crash the car and the insurance company comes back and gives you a 1980, Yugo, all rusted out, doesn't run very well, well, you're going to want your $100,000 BMW back. So hopefully you have replacement value coverage on your vehicle as well. Well, when it comes to life insurance, there's also the idea and the concept of replacement value. So in a case like this, where we're talking about, say, a 30-year-old with a wife and 2 kids, could be male or female, doesn't matter. In this case, I'm just talking about a male, a guy. Statistically, by the way, guys tend to die, women tend to linger. That's why long-term care insurance is more expensive for women and life insurance is more expensive for men at the same age, all else being equal, interestingly. So, but in this case, we're talking about a guy, he's 30 years old and he's going to work another 30 years and earn $150,000 a year. So in this case, how much insurance, what is the correct amount? What would his family lose? And so I'm going to share my screen and I am going to go to a calculator from a company called Leap, a software that we use at Del City Capital often. And we're going to calculate something called economic life value. And so the gentleman's present income is $150,000. This guy's and wife, 2 kids. And he's going to work 30 years. And he's going to get raises at least equal to the inflation rate. Now, the Federal Reserve has a target of inflation or inflation of 2%. I'm going to use 3%. I'm going to assume it's going to be over the target for the next 30 years. Who the heck knows, right? It can be even higher. But what we want to do is grow a pot of money at some reasonable net after-tax rate of return that will replicate the earning stream of this gentleman. And in this case, I'm going to use 6 Maybe 5 is better. I wouldn't go any higher than 6. But in a case like this, what this table is telling us is that if he were to die tomorrow, this this gentleman, 30-year time horizon of work, 150,000 a year in income, you would need $3 million, or he would need $3 million in coverage to replicate his income for the next 30 years. Okay. And in year 2, and in year 3, and in year 4, you can see that what's happening is these amounts are going down because the surviving spouse is taking that $150,000 a year, adjusted for inflation, and hopefully saving 20% of it to replicate what was lost in savings for retirement and using the rest to live on. And so that's the correct amount of life insurance for this guy in this case, about $3 million worth of coverage today. Now, let's bring it all home and let's compare these 3 different approaches. And I'm going to share my screen again. I'm going to go right to this Excel spreadsheet that I put together, and we're going to look at these 3 different approaches. So the first approach is the rule of thumb. And this rule of thumb approach, again, very common on the internet, to read blog posts or articles where you just, rule of thumb, real quick and easy, simple, done. 5 years of my income replacement, 750 grand. I earn $150,000 a year, and I want my spouse to have 5 years of my income. But after that, he or she is on his or her own, and sayonara, and that's it. So kind of a bare bones approach. Better than nothing, but still woefully underinsures the family, the person for the family. And so the surviving spouse in this case is going to have some economic issues down the road, especially if he or she is a stay-at-home parent. Okay, so another consideration. They're going to have some real issues, and they're going to have to change their life quite dramatically than what the plan was. So that's the rule of thumb. 5-year income replacement, you could use 10 years, you could use 3 years. But quick, easy, and generally woefully underinsures the person if you don't use an adequate number of years of work. The next approach is a needs-based approach, and not necessarily bad. You say, well, okay, what do I want to have happen? I've got a mortgage is 400 grand. I want that to be gone from my spouse. I want that mortgage to be paid off. I want to set up a college fund, and we'll say with $150,000 in it for my kids' education. And yes, I still want income replacement, 5 years of my income, $750,000. And that results in $1.3 million in coverage. Again, not bad. It's certainly better than $750,000. Okay. But again, underinsured compared to the replacement value or economic life value approach. So over here, the last column in the table, we assume that this young man is going to work 30 more years, and he's going to earn $150,000 a year, but he's going to get raises for inflation. By the way, we're not taking into consideration maybe he's going to work another job. Maybe he's going to get some bonuses. Maybe his income is going to go way up to the stratosphere. So this approach could still result in a lower amount of insurance than the technically correct amount, but it's much better than the other 2 approaches. So 30 years of work, raises equal to inflation, a 6% rate of return on the pot of money that's going to grow and replicate his income stream should he die tomorrow. That results in $2,995,000 worth of death benefit for the family. Now, believe me, if someone passes away, a surviving spouse, my guess is will never, ever, ever say when the insurance agent goes to deliver the check that, oh, that's too much. It's too much insurance. No, I don't want that. right? Of course not. It's kind of silly. But what is the issue really when it comes to death benefit and life insurance? What is the issue? It's cost. You see, if life insurance were free, we would all have at least economic life value, which technically is the most we could have based on the idea of insurable interest and what is at risk or replacement value. You can't insure your home for $5 million if it's worth one. You can't insure your life for $5 million if your income stream replacement or your economic life value is $3 million. So you get the idea, right? But we would all have as much insurance as we possibly could if it were free. Well, of course, it's not free. And so cost is always a consideration. Cost of insurance is based on things like the type of insurance, term insurance versus whole life insurance, versus something called universal life insurance, how old you are. The younger you are, the less the cost of the insurance is when you take it out. What about health? If you're an athlete and have a resting heart rate of 40 and you're 30 years old, then certainly the chance of you passing away is less than a 70-year-old who smoked 2 packs of cigarettes a day and shot their quart of bourbon every day. And maybe that person can't even be insured. So your age, your health, and also whether you're male or female. As I said earlier, males tend to pass away, women linger. And what I mean by that is all else being equal, the cost of, say, $1 million life insurance policy on a male versus a female, it's going to be more for the male. And as you probably know, females tend to live longer. Now, when it comes to long-term care insurance, it's the flip side of that. If you've ever been to a nursing home, for instance, you'll know that most of the people in a nursing home are female. That's because women tend to linger, men tend to pass away. And so life expectancy, again, all else being equal, women have a few years on men. So your age, your health, your sex, male versus female, all things to consider when it comes to how much your insurance is going to cost, in addition to the type of insurance you decide to take out. So I think I'll end this with just an idea that some insurance is better than no insurance. Consider all the different factors and weigh your options when it comes to cost. But make the starting point of your decision is if you can get economic life value insurance for your family, do it. And start there. And then if you need to make changes to the amount of insurance because of cost, then do it. But start with a calculation of what is your economic life value. One more point I want to make. There is economic life value for a stay-at-home parent. Big time. Okay. So even if you don't work, there is still an economic life value, meaning work outside the home. So don't think because if you're a stay-at-home parent, there is no economic life value. There's a big economic life value to the family. Okay. So again, make the starting point of your decision. What is the economic life value for me, for my spouse? What is at risk? Is there an insurable interest? Feel free to reach out to us at Del City Capital Management. We'd be happy to help you with the calculation. We hope you subscribe to the Happiness Retirement Program podcast at Spotify or Apple, or at www.delcity.com with a hyphen between the L and the S. We hope to see you next time for episode 3, season 1 of the Happiness Retirement Program podcast. And we've got a really exciting show in store for you. I think I'm a little geeky, but I think you're really going to enjoy it, where we blow up an island, meaning we may change your paradigm about the miracle of compound interest. Okay? So the miracle of compound interest creates a potential compound tax. And what can you do about that? Hope to see you next time. Again, this has been the Happiness to Retirement Program podcast. I'm Bill Dale Setti, because the road to retirement should be an adventure, not a survival strategy. Talk to you soon.